All right, so we went over the weekly income iron condor as our first strategy, and now I want to talk about strategy number 2, which is the weekly income double calendar. Now, I actually like the double calendar a little bit better than the weekly income iron condor. Reason being is you use a little bit less risk, the win rate is a little bit better, and overall, it's just a little bit smoother of a ride than the weekly iron condor. Let's jump in to how we set this up. Trade entry. It's going to be very similar to the iron condor from a standpoint of kind of our range that we're using. And in this case, so we're selling a 40 delta call in the front month. And let me back up because calendar spreads are a little bit different animal. And if you've never traded calendar spreads, they may seem a little bit confusing at first. And that's only because we're trading options in 2 different expiration cycles. And we call it a front month. And I should actually change that to front week and back week. Okay. So you're trading options in a certain days to expiration, and you're trading another one in a different days to expiration. So it can seem a little bit complex at first if you've never traded calendars, but I promise we're going to break it down for you. It is going to be no big deal, and I think you'll probably gravitate a little bit more towards this one than you will the weekly income iron condor. So again, in the front month, or I should say front week, we are going to sell the 40 delta calls, and then we're going to take that same strike in the back week or back month in the later dated options, and we are going to buy that same strike. Okay, and then same thing on the put side. We're going to sell the 40 delta puts. We're going to look at that same strike, and then in the further dated options, we are going to buy those puts. So the time frame is the same, and the expiration, it's all based on the front month expiration or the front week expiration. In this case, is between 6 to 8 days to expiration, so 6 or 7 or 8. Doesn't matter, depending on your preference. And then we're going to choose the further dated expiration cycle with between 20 and 22 days. Okay, so if you are entering the front cycle with 6 days, the back is going to have 20. If you enter the front with 7 days, the back is going to have 21, 8 and 22, and so forth. Okay, we always want to keep that same time frame ratio between the front cycle and the further dated cycle. And then lastly, I noted here, you want to enter on a day when IV is contracting. Okay, so here's the difference. Remember, on the weekly income iron condor, we said we want to enter when the IV is expanding. So we would enter that if the market's going down, implied volatility is expanding. That's when we would potentially look to enter the weekly income iron condor because we benefit when it contracts. If implied volatility has already contracted, so if you're entering one of these when the market is up, that implied volatility is typically contracting on a day like that, that's when we would look to enter one of these weekly income double calendars. Reason being is because these benefit from implied volatility expansion. So if we can get in after implied volatility is contracted, we've only got 7 days left or 6 days in the trade. If we can get a little bit of cyclicality, a bounce or an expansion, an increase in implied volatility, that's actually going to benefit this trade. Now, don't get too caught up on IV contraction and IV expansion with these things. I mean, these are things that we're just going to be putting on, on a systematic basis. The other thing I don't think I mentioned before is we're not going to pay attention to the actual level of the implied volatility. Okay, like with our monthly income, we like to put those on when IV percentile is over 50 or IV rank is over 50. With these weekly trades, we don't care. We're going to just put them on, take them off, put them on, take them off, regardless of the level of IV. The reason I mention, enter on a day when IV is contracting is just because these benefit from an expansion. So if we can get in and buy these at a cheaper price and then sell them and get a better price if implied volatility expands, then that's kind of the nuance. That's the goal. Now, keep in mind, we don't know what implied volatility is going to do, right? So, it could contract for 6 days in a row throughout our trade, and that would actually not benefit a double income calendar, but it would benefit an iron condor. So you never know what it's going to do. I'm just trying to play a little bit contrarian here to try to get a slight little edge and, enter these when implied volatility is contracting and enter an iron condor on days when implied volatility has expanded. All right, let's take a look at a screenshot on TOS here of entering. And so what you'll see here is 6 days to expiration, in this case, is the front cycle. And we're going to sell the 40 delta calls, which in this case would be the 29.60 strike. And we're going to sell the 40 delta puts. So that's around the 40 delta. That'd be the 29.35. Then we're going to go out to 20 days to expiration. So the front is at 6. The back would be at 20. If this were at 7, the back would be at 21. If this were at 8, back would be at 22. Okay, so always just keep those ratios confirmed. And then keep in mind, and I wrote here, you're going to buy the same strike. The delta will be different. So when you buy it out here, it's not going to be the 40 delta. In this case, it's 46, but we're doing the same strike. So it's the 29.60 on the call side in the front. It's 29.60 in the back cycle. Sell the 40 delta put here. That's the 29.35. We're going to choose the same strike in the back cycle, which is the one we're going to buy. So we're going to sell the front cycle, and we're going to buy the back cycle. Now, why does that make sense? I want to make sure that from a conceptual standpoint, you kind of understand why that makes sense. And the reason is think about this. The closer you are until expiration, the quicker those options decay. So we're selling the ones in the front cycle that are going to decay quicker. Then we're buying the longer dated, the further dated options because those won't decay as quickly, and that's going to define our risk. So that's how a calendar spread works. And in this case, we are entering it as a double calendar. So we're doing a calendar on the call side, and we're doing a calendar on the put side simultaneously, and that's what we call a double calendar. So this is what it's going to look like. When you take it over to the risk profile on the Analyze tab on TOS, that's what it'll look like. Kind of looks like a tent with a little bit of a droop in the middle. Those are their short strikes. That's where the kind of the break in the line happens right there. Okay, so you got the 29.35 and the 29.60. That you can see that's where that little break in the line happens. You can see about a 55% probability of profit. Keep in mind, depending on where implied volatility is, these are going to have a little bit different probabilities when you enter. The other thing to keep in mind about calendar spreads, in this specific case, double calendars, is this max profit and these break-even lines are not static. Okay, remember, when we enter an iron condor and you set your break-evens at order entry and you see your max profit, those are static throughout the life of the trade. With a double calendar, those are not static. Okay, your break-evens can expand and contract throughout the life of your trade. Your max profit can expand and contract throughout the life of your trade. What is static is your risk on the trade. In this case, in this example, we're buying this for a debit. You're paying $23.25. Multiply that times 100. So $2,325 is your debit. That's what you're paying, and that is your absolute max risk. So when you buy a calendar, you're paying a debit for it. So you want to buy it for a lower cost and sell it for a higher price. Buy low, sell high. Whereas opposed to if you're selling an iron condor, you're selling to open, you're opening that for a credit, you want to sell that for a higher price. Implied volatility contracts, time gets closer to expiration, you buy that back at a lower price. So you're selling high and buying low on an iron condor. You're buying low, selling high on a double calendar. Hopefully that makes sense. Now let's talk about the trade exit. Trade exit is very similar, except for the fact that our stop or our exit point is going to be, instead of being at 50% of max profit, it's 25% of the initial debit paid. Remember that debit you pay for a double calendar is the static, that the max profit on a double calendar is going to go up and down. So we're not basing our exit point on a percentage of max profit because that's going to fluctuate. We're basing it on a percentage of the initial debit paid or the max loss amount. And in this case, it's 25%. When it comes down to the overall risk from kind of a dollar perspective, it's very similar to that of a weekly income iron condor, but we've got to use the debit paid as kind of our metric to calculate that percentage, not the max profit. And then same thing here. We're going to exit when we get down to 1 day to expiration. There are no adjustments and no roll. So we're either going to get stopped out, we're going to exit the trade at our predetermined stop point, or we're going to exit once we get down to that 1 day to expiration. So let me bring up the platform and I'll show you how to enter one of these. So let's uncheck the Iron Condor. We'll leave it there. And then we're going to go to the trade tab, go to that same 7 days to expiration, that 40 delta. And on toss, you can do it a couple different ways. You can right click, buy. You're going to buy. You can go to double diagonal and then choose double calendar. And this is the front cycle, the July 10th. We need to look out in the future to see the 21-day cycle, which in this case is the July 24 cycle. So we want to change this to July 24. So the ones we're buying is further dated, the July 24. So you can see the ones we're selling are the July 10th with 7 days to expiration. The ones we're buying are the further dated, 21 days. At July 24. Okay, so those are changed. Now we need to go back in and we need to make sure we change our strikes, right? Because it just defaults all to the same strike. So that's not what we're looking for. What we're looking for is we're going to sell the near dated 40 delta, which is this one here, the 3005. That is populated right here, the short one right there. And then on the put side, let me kind of do this in a better sequential order. So we're going to do that. We're going to right click. We're going to buy that. Double diagonal, double calendar. That's going to populate just like you see here. We need to make sure that we have the correct expiration cycles. The one we sell with 7 days to expiration, the one we buy with 21. And then the call will automatically be populated at the 3005. Then we need to go ahead and change the long call to also 3005, which it's already there as well. Okay, so you got 3005 call, 3005 call. That's the one we're selling. That's the one we're buying. Okay, then we go over to the put side and we look for the 40 delta here. It's got a 41 delta. That'll work. 29.90. That's the strike we want for the puts. So we can just change both of these to 29.90. So that's what it's going to be. We're going to right click. We can take that over to the Analyze tab. And like you see, it's very similar looking to the screenshot that we just showed. You can squeeze it over here. You can see it's absolutely defined risk based on the amount of debit that you paid for the trade. And so that's what it's going to look like. So, basically that's how you can set it up in TOS. You can do it as kind of one transaction as a double calendar. The other thing you can do if you're not used to trading double calendars, but you understand single calendars, let me uncheck that. You can actually go ahead and input this as individual calendars too, where you just start with the call side, right click, buy calendar, and then you make sure you change your expiration dates to the correct dates. We're selling the July 10. We're buying the July 24. We're selling the one with 7 days. We are buying the one with 21 days, and that's at the 3005. Okay, then you can just right-click, take that over to the Analyze tab. That's a single calendar. Then you can come back to the Trade tab, do the same thing on the put side, and just right-click, buy calendar, change your expiration date to the one you want, and that's a single calendar, and you can analyze that. Now, if you're analyzing both are checked, guess what? It looks exactly like the double calendar, right? So all we're doing is we're buying a call calendar, and we are buying a put calendar, and combine those are double calendars. You can get these filled in your platform in one single transaction, which is what I like to do. But if you need to piece it together like that to make it make more sense, you can do that as well. All right, so that's how you set it up. Now, let's go over to the one thing I want to do here is I also want to go over to Tastyworks and do this on Tastyworks. I know some of you all use different brokers. Our preferred brokers are Tastyworks and TOS, so I want to show you on both of these. Same thing. So in this case, it's pretty easy to set up an Iron Condor. You're just going to, and don't mind that, that's a position that I have on in there. But in this case, again, just look for the 40 delta. You just click on the bid to sell, and you just click on the ask to buy. So we're selling the 40 delta. We're going to find the 10, let's say 11. Click on that to buy. And then we're going to go over to the put side, 40 delta, sell the 40 delta, and buy the 10. Okay, so that's an Iron Condor. If I clear that out, and then I want to do the double calendar, same thing. You can just click on the bid and the ask. So we're going to sell the 40, sell the 40. Then we need to go out to the next expiration cycle, and that would be the one with 21 days. We're going to open that up, and we're going to buy the same strike. And if you need to reference them, Tastyworks puts them right down here. So on the call side, it's the 3005. So we're just going to buy that one. And then we're going to buy on the put side the 2990, which would be that one. So we just buy that. And then it populates all of them in there for you. So now you have a double calendar. You can see the ones you sell have 7 days to expiration. The ones you buy have 21 days. They're the same strikes, just different expiration cycles. You can kind of check that. The price is right there. And then you can hit review and send. So I just wanted to show you that as how you do it in Tastyworks. Both Tastyworks and Toss make it pretty easy. If you have a different trading platform, you just need to make sure you're following the steps that we've already laid out. All right, so that is that. Some recent trades that we've done in the double calendar. I mean, these have just been great trades. Put this one on June 18th, just a couple weeks ago. Took it off on the 21st. So you'll notice I was only in this for 4 days. The reason being is the 21st was a Friday, and we'd already gained so much of the profit of this trade. I just didn't want to hold it over the weekend just for a tiny bit more profit, so we went ahead and closed it. Total capital used, $33.40. So you can see our debit paid was $33.40 times 100. That's $3,340. Capital used. Booked a profit of $11.10. That's 33% return on capital in just 4 days. Another recent trade. This one we put on June 20th, just about a week and a half ago from the time of this recording. Took this off 7 days later. We bought into this for $29.20, booked a profit of $12.25, 42% in just 7 days. So you can see how great these can be from a quick profit standpoint.